Hello everyone, a very warm welcome to another episode of Trade Insider, a podcast series brought to you by the International Chamber of Commerce Academy. My name is Priyanka Satapathy and I will be your host for this episode. The 2021 edition of the ICC Trade Register was released last month. The report that draws on information from 21 member banks present a global view of the credit risk profiles of trade and export finance transactions and supply chain finance transactions, along with the newest insights on global trade finance default rates from both 2019 and 2020. The report also features several topical contributions and commentary on global trade from leading experts, and one of them focuses on how the register data can be used for IFRS 9 reporting. In this episode, we are speaking with the chair of the ICC Trade Register, Krishnan Ramadurai, who will be talking about trade finance exposures and the interplay with IFRS 9 accounting treatment, which drives the level of provision and losses in a bank's trade finance portfolio. Krishnan, a very warm welcome. Let's get started. Can you explain the International Financial Reporting Standards, the IFRS 9, in simple terms, and why is it different from existing accounting standards?
Morning, and thank you, Priyanka, for having this session. Specifically to your question, IFRS 9 is a new accounting standard which replaces the old International Accounting Standards 39 and requires banks to calculate credit loss provisions on all banking book assets such as loans, overdrafts, and off-balance sheet contingent items like letters of credit and guarantees based on expected credit loss models. The new accounting standard makes fundamental changes in the calculation of provisions as IFRS 9 adopts an expected loss methodology which incorporates forward-looking macroeconomic scenarios and uses historical data as one input in determining impairment charges. This effectively means impairment charges are recognized when a loan is booked initially. By contrast, the old accounting standard under IAS 39 can be described as an incurred loss model, where a trigger event needs to happen before an impairment charge can be recognized. This trigger event may be a missed payment of principal or interest and can include a part repayment of a loan. In essence, the old methodology looked at past events and current economic conditions in determining impairment charges and did not incorporate forward-looking information or data, which IFRS 9 does.
Could you tell us how the IFRS 9 will impact trade finance exposures, and also how is it linked to the recently released ICC Trade Register?
As every loan and receivable exposure booked on the balance sheet of a bank carries with it some risk of default, individual loan and overdraft exposures, including off-balance sheet contingent items related to trade finance portfolios, like letters of credit and guarantees, will have an expected loss attached to it. Banks are required to calculate an allowance for credit losses by considering on a discounted basis the cash shortfalls banks would incur in various default scenarios for prescribed future periods, with the cash shortfalls being weighted by the probability of each of these scenarios occurring. The allowance or expected loss is the sum of these probability-weighted outcomes. As ECL calculations will influence returns at an individual loan and portfolio level, the business will need to have an understanding of these calculations. To build these forward-looking expected credit loss models, banks require access to robust long-term data at a product level to enable them to calibrate provisions in an accurate manner. The trade register is one such source of significant information as it collects this data from a number of global banks on an annual basis. This in turn allows individual banks to use the trade register data as a benchmark to calibrate their ECL models.
Given the importance of ECL calculations, can you touch base on the methodology behind these calculations?
As a starting point, ECL models need to account for future macroeconomic scenarios. This is a required element of IFRS 9. ECL models and their calibration will have a direct impact on bank profit and loss statement. A good illustration of the sensitivities of these macroeconomic scenarios is the 2020 year-end P&L numbers reported by banks globally, which were influenced by the COVID-19 pandemic, resulting in big increases in expected credit loss provision charges. And the June 2021 P&L numbers reported by banks globally, which show some reversals of the ECL provision charges booked earlier in December 2020 on the back of improving economic sentiment reflected in increasing economic activity and a pickup in GDP numbers. As part of this process, banks are required to reappraise their loan portfolios on a regular basis to classify every individual loan into three buckets. Stage 1, performing asset loans are initially booked as loans that are subject to a 12-month probability of default. This is essentially the performing book of the bank and tends to make up a significant percentage of the overall loan book. Stage 2 are underperforming assets or loans exposures that are deemed to have experienced a significant increase in credit risk, often triggered by an internal credit rating downgrade, causing the probability of default of the loan to increase. Importantly, from an ECL modeling perspective, the bank needs to calculate the ECL over the remaining life of the asset. For short-term trade finance exposures with a lifespan of less than 12 months, there is no effective difference between lifetime and 1 year expected loss calculation. For longer term transactions, the expected credit loss multiplies quickly and can have a large profit and loss effect. For example, financial and performance guarantees, which can have longer maturities, sometimes greater than 5 years, the cumulative probability of default over a 5-year period is greater than the 1-year probability of default, meaning the effect of moving from stage 1 to stage 2 for any longer term trade transactions can be substantial. Stage 3 are called non-performing assets, where loans are in effect defaulted loans on which banks will need to stop accruing interest income and make a judgment call on the likelihood of losses, taking into account cash flows, collateral held, and time to recovery.
Okay, I would like you to elaborate on the mechanics of how ECL is calculated at each of the 3 stages.
Yes, a simplified way to think of ECL is that the expected credit loss is a function of the probability of default multiplied by the loss given default multiplied by the exposure at default. The exact IFRS 9 stage 1 formula takes into account the point in time values of probability of default, loss given default, exposure at default and adds another parameter, which is tenor, to account for the present value of future expected credit loss. The IFRS 9 Stage 2 formula, which looks at lifetime expected credit loss, is more complex as it adds expected credit loss for each remaining year, taking into account the residual tenor of the transaction and discounts it to the present value. Stage 3 is when a customer is in default. In such scenarios, there are no models. Instead, the expected credit loss is based on local expertise and judgment of the recovery specialists who review the parameters in relation to collateral held and incoming cash flows to assign a discretionary value to loss given default as the primary determinant of ECL numbers.
What type of data do you need to build ECL models? And how different is this data requirement from the data needed to build regulatory risk models?
To build expected credit loss models, banks need a time series of historical data at a product and facility level of defaults and losses. Note, unlike regulatory models, which prescribe the number of years for which data needs to be collated, expected credit loss models are not prescriptive in nature. The more granular the data, the better they will reflect the portfolios in question. Banks that have access to sufficient internal data on trade finance products can incorporate this data into their IFRS 9 ECL models. This will enable banks to use internal historical data in conjunction with the trade register data as a benchmark to prove the lower volatility of short-term trade products, defaults, and losses, and avoid making incorrect assumptions in their IFRS 9 expected credit loss models. Additionally, the CCF or the credit conversion factor can be modeled for off-balance sheet facilities like guarantees and letters of credit in the IFRS 9 expected credit loss models. For guarantee facility, the credit conversion factor will be based on the paid amount or on-balance sheet exposure divided by the issued amount at the time of default. This represents the probability that an issued off-balance sheet exposure will become an on-balance sheet exposure after default. For example, take a facility which before default has a 30 million limit and has 25 million of issued guarantees. At default, there are 25 million issued guarantees outstanding against the 30 million guarantee limit. After default, in a workout situation, we find that 23 million of guarantees were never claimed or not paid out, remained outstanding, and retired as usual on expiry of the guarantee on the due date. But 2 million of these 25 million guarantees were claimed and were paid out, resulting in a 2 million of on-balance sheet exposures. And on closure, we realized a 1 million loss, which was written off to the profit and loss account. Using this example, we can prove that the credit conversion factor is 8%. How did we arrive at that? 2 million paid amount of guarantees divided by the 25 million of issued guarantees. With this method, the paid cash exposure is divided by the issued guarantee exposure. The loss given default is 50%, being 1 million loss divided by the aggregate amounts of cash outstanding at the time of default or during workout, being 2 million as above. Note that this excludes discounting of cash flows. By contrast, regulatory models are more prescriptive as they require 5 years of historical data for modeling probability of defaults and 7 years of data for modeling loss given default. Regulatory models also need to build in an economic downturn impact and a margin of conservatism within their models. Some regulators do not allow for credit conversion factor modeling of contingent liabilities.
What do you think banks can do to optimize ECL in trade finance?
Trade finance teams can have a number of options to optimize ECL. Given the close linkages between the expected credit loss modeling calculations and the risk-weighted assets calculations, they can structure transactions which are short-term in nature. They can increase collateral or factor in risk mitigants within the structure, like credit protection or insurance. And they can also focus on setting limits properly so that there is a reduction in the undrawn exposure, as history tells us that utilization of limits never exceeds 60% of the facility granted to a customer. Addressing the points outlined above within transaction structures will help in generating lower expected credit losses apart from lower risk-weighted assets. And additionally, given the short tenor of trade transactions, it will not create expected credit loss spikes in times of credit deterioration when exposures move to stage 2. They can also then look at ensuring there is enough data collected systematically and stored in an accessible manner to be used in risk models to support a favorable trade-specific loss given default. This data can also help in differentiating loss given default for trade versus other credit and lending products in expected credit loss models. And finally, they can provide credit conversion factors based on empirical data to the IFRS 9 modeling teams, as often they may not have the data on trade products at a granular instrument or product level. Modeling credit conversion factor of guarantees and letters of credit based on this data can lower expected credit loss charges and boost profits of the trade portfolio. As ECL computations is generally managed centrally by the bank through a dedicated team, they are not necessarily experts in trade. Therefore, the trade finance team will need to do the things outlined above to optimize expected credit loss calculations for trade.
Can you provide our audience with an example of how the expected losses for a performance guarantee and a financial guarantee will be calculated using empirical data?
The empirical credit conversion factor, which is derived from the example discussed earlier, is the primary driver of exposure at default. And this parameter is estimated by the following formula. Empirical credit conversion factor at a customer level is defined to be the total monies paid out under claims made for a guarantee type, whether it is financial, performance, or customs duty guarantees, but claimed after the date of default, divided by the total outstanding exposure of the same guarantee type as on their date of default. A bank can then take the average of all such customer level credit conversion factors for a particular guarantee type and for the geographical region that they intend to build the model for. While the default regulatory credit conversion values for financial guarantees is 100% and performance guarantees is 50% or 20%, the empirical data points to a lower credit conversion factor for these guarantees. The benefit from applying empirical credit conversion factor to these guarantees is material, and will help banks with a large guarantees portfolio to lower expected credit loss calculations. Sample calculation shown below assumes that the empirical credit conversion factors for financial guarantees is 30% and performance guarantees is 10%. The example below shows you that for a performance guarantee portfolio of roughly 20 million, a probability of default of 1%, a loss given default of 40%, and a regulatory credit conversion factor of 50%, we get an empirical credit conversion factor of 10%, which effectively means the expected credit loss comes down substantially. You can see the expected loss of 40 using regulatory parameter reduces to 8, giving you a benefit of 32. This is similar case when you look at financial guarantees. I will not regurgitate the calculations, it's self-explanatory.
Will the ECL methodology that you just explained so well also come under US generally accepted accounting principles?
US GAAP methodology in many ways is similar to the IFRS 9 methodology because they use the same risk parameters or individual risk components as the IFRS 9 calculations do. The fundamental difference is in the use of lifetime probability of default for stage 1 calculations under US GAAP. As the trade portfolio is generally short-term in nature, this is not likely to be a major driver of differences in ECL calculations between US GAAP and IFRS 9. However, for longer tenor transactions, ECL calculations under US GAAP are likely to be higher than IFRS 9.
We will move on to professional development at this point. As we are the educational arm of the International Chamber of Commerce, we would like to talk a little bit about the importance of professional qualifications. The pandemic has massively altered the trade finance landscape. It is being realized by both individuals and organizations that the time for reskilling and upskilling couldn't be more pressing than now. I'm sure our audience would appreciate hearing your opinion on this.
Yes, as the scale of change is unprecedented and can be termed in some sense as a paradigm change, which is uprooting not just the individual ways of working, but reconfiguring supply chains from just in time to just in case, ushering in a new era of price pressures with knock-on consequences for inflation and accelerating the use of technology. Trade is changing in ways we are not familiar with. And if you add on ESG related factors, we are in essence in a brave new world, which will require new skill sets. This also poses questions for professional training providers who will now need to change to provide trade finance professionals with these new set of skills.
Krishnan, you have authored one of ICC Academy course titled Capital and Pricing, which is part of our trade finance program called the Global Trade Certificate. Can you provide some insight into the relationship between capital pricing and the IFRS 9?
This is a very relevant question. And I would say that the underlying parameters, which are basic inputs to determining capital risk-weighted assets, pricing, and expected credit loss models are similar, but not identical. What do I mean by that? Well, when you look at estimating probability of default of an obligor, while capital and regulatory models will use a 1-year probability of default, expected credit loss models, while using 1-year probability of default as part of estimating stage 1 expected credit loss, will switch to using lifetime probability of default for stage 2 expected credit loss calculations. And this can have a material impact on expected credit loss numbers, as we saw in December 2020, when the impact of COVID-19 rippled through the economy and the banks. When it comes to pricing, let me say there is a direct link as expected credit loss calculations are a vital input in pricing models, as they are a cost of doing business. So, in essence and in summary, there is a link, but the devil is in the detail.
Thank you very much, Krishnan, for taking the time to record the session with us today. Trade Insider listeners, if you would like to build a comprehensive understanding of global trade finance, we offer industry-validated professional certifications in 2 levels: the Introductory Level Global Trade Certificate and the Advanced Level Certified Trade Finance Professional. Both the programs can be taken online with a 12-month access period to complete the core and elective courses, followed by a live proctored final examination. On passing the final exams, you will get to join the ICC Global Alumni Community, where you get to stay connected with trade finance professionals from over 170 countries. And if you're keen on keeping up with all the changes that is happening within global trade finance industry, do sign up for our monthly newsletter. The subscription link is available on our website, icc.academy.